The demand for commercial real estate debt is probably $3.5 trillion over the next 5 years. And the real question is, where is that going to come from?
All right. Welcome, everyone, to The Landscape. This is George Smith Partners' monthly podcast. We're very excited. This week, I have a special co-host, Mr. Jonathan Siebolt. Jonathan is a senior director here at GSP. We're very glad to have him. Jonathan is also an adjunct professor at the NYU Schacht Real Estate School and has extensive experience in capital markets, capital placement, structuring complex transactions, and an interest in CPACE and other types of esoteric financing. We're very glad to have Jonathan here at George Smith Partners. I'm going to let Jonathan introduce our special guest today, but before I do that, just want to remind everybody that if you're not subscribed to our newsletter, FinFacts, go to George Smith Partners, gspartners.com, and sign up for FinFacts. And of course, you can subscribe to this podcast on Apple, Spotify, and YouTube. So, Mr. Siebolt, over to you.
Great. Thanks, Evan. So I'm pleased to introduce Warren Haan, the founder, managing partner, CEO of ACORE Capital, with over 20 billion of AUM, nearly 40 billion in transactions since its inception in 2015. ACORE is one of the leading credit managers specializing in first lien debt, mezzanine debt, and preferred equity investments. Under Warren's guidance, ACORE has risen to prominence in the industry. This is really marked by his roles at notable firms like Starwood Property Trust, Countrywide, and his regular recognition in the Commercial Observer as the CRE Finance's most influential figures for 7 years running. Beyond his professional achievements, Warren's also celebrated for his commitment to philanthropy, particularly in supporting children with special needs, a cause for which the Help Group honored him in 2016. Warren holds a Bachelor of Science from the Cornell School of Hotel Administration and diploma from the Hotel Institute of Montreux in Switzerland. And Warren's career is distinguished by his financial acumen, as well as his dedication to making a meaningful difference. So, Warren, I will hand that over to you if you have any additional remarks.
Hi, everyone. It's great to be here today, and look forward to our conversation. And thank you, Jonathan and Evan, for having me.
Glad to have you. So why don't we jump right in here? Why don't you introduce ACORE a bit to our audience here and talk about your core investment strategies and the type of assets you're most focused on, maybe historically and also today. So we can kind of set the stage for a bit of a discussion, both on the commercial real estate market, maybe the economy in general, but set the stage for what is ACORE and who are you?
So thanks. So ACORE is one of the largest non-bank lenders. We're a non-bank bridge lender, also known as a transitional lender. We, as Jonathan mentioned, have about $20 billion in assets under management. We have 126 people in 5 offices around the country. And our focus is really making loans on top quartile assets to top quartile borrowers and top quartile markets. And our primary focus is on assets that are in transition. So these might be multifamily assets that are in lease up. This could be a retail center that is being repositioned. This could be a hotel that's being rebranded, or an industrial building that is going through a change in leasing. We also have a very sizable construction book of about $3 billion at any point in time. We do ground up construction across all product types. And our focus, having built multiple commercial real estate finance businesses in the past, is to focus, like we all do, on the relationships, but fundamentally to provide white glove service to our borrowers and provide them with a very smooth and finance partner oriented relationship, where we truly are the finance partner to the equity folks and those that are creating a lot of value and building buildings and so on, and we're the financing partner.
That's great, Warren. Given sort of the environment that you play in, particularly as it pertains to more opportunistic type investing, and that coupled with the cyclical nature of real estate markets today, how are you approaching risk management, both at ACORE and broadly speaking, particularly given the negative leverage environment that so many borrowers find themselves in with this wall of maturities?
Yeah, there's a lot that you said in that, Jonathan, that needs to be pulled apart a little bit. I think the hallmark of 2023 for all of us in the lending business was risk management. I mean, it was the speed with which, it was the order of magnitude, but also the speed with which the Fed increased rates that fundamentally broke the system. And the system broadly is the cost and availability of debt capital, which really is the engine that drives transaction volume at the end of the day in commercial real estate. So for us, I remember a conversation with one of my partners the minute that Russia invaded Ukraine. I said, we have to go into defense mode. And my intuition was, having come through multiple cycles, that we were in for a difficult time globally. And certainly that global knock-on would be impactful to commercial real estate. So we fortunately built out an asset management team, currently has about 40 people in Dallas, managing about 260 loan positions. But that particular team has become very busy. I mean, that team, when we started ACORE in 2015, we decided to build a business that had scale in terms of capitals, so always in the market, availability of capital, scalability of human resources, very important too, and then an ability to service this big platform. And one of the decisions we made was to build out an asset management team that could handle this. And to be honest, before COVID hit, managing a portfolio of performing loans wasn't that complicated. And having a lot of bodies doing that, I oftentimes questioned, were we crazy to build that asset management team out? When COVID hit, it was emergency. We were all in the emergency room, as you remember. And I would tell you that our asset management team was working harder than they had ever worked. And it was borrowers picking up the phone and calling with real emergencies. Their cash flow had gone to zero in the hospitality. At the time, we had 52 loans, hospitality loans, roughly $3.5 billion. And we ended up modifying every single one of those loans, okay? In today's environment, obviously it was the middle of last year, we had inflation up around 9%. That was a historically high number, but it was really the speed within which that inflation kicked in, really coming off the tail of a lot of government stimulus off of COVID and also prosperity in the market. And then the way in which the Fed had reacted from a rate perspective was so rapid and fundamentally violent that it shook the core of the banking system. Shaking the core of the banking system is actually more problematic than most people know. About 70 to 75% of all commercial real estate loans in the banking system are made by regional and local banks, not by the big banks, JP Morgan, Wells Fargo, and so on, but by the small name banks that many of us don't really associate with. That is the core of liquidity or debt liquidity in commercial real estate. So once that kicked in, we found ourselves to be, all of us in commercial real estate, in a lockjam where everything was locked down, interest rates had risen, it was very difficult to refinance your loan, and those loans that didn't have interest rate caps were running up against an interest rate that was 3% when they made the loan, and all of a sudden it's 8-9%. And we all know, and I know there's a lot of borrowers on this call that are George Smith Partners clients, that when you look at that fundamental change in your expenses, something has to give. And I think the story that hasn't been told yet is the story of rate cap expirations. And as that manifests itself over the next 6 to 9 months, in 12 months from now, when we look back, I guarantee you the story we're all going to be talking about is that properties were starved of cash because it was used to pay debt service. So we're going to start to see some issues from a physical plant perspective. So how have we managed risk? Fortunately, we have 126 people. Fortunately, we have 40 people purely dedicated in asset management. We have 27 originators. And that whole team came together very nicely through this process to help modify, whether it was light modifications or extensive modifications. And then in the latest number I have, in 2000, the trailing 12, we've modified about $14 billion of loans in one way, shape, or form. That can be a light modification or a more extensive modification, and that's almost 200 loans. Now, that could be very small changes to the loan agreement all the way up to additional fundings or otherwise. And so part of risk management is having a dedicated team on the ground that is there to help support the real estate ecosystem, to help support you folks who are advising your borrowers, to help the borrowers directly, and to help, rejigger cash streams such that we can be supportive of the borrower's business plan. And fundamentally, we think we're going to get to the other side. So the drivers of this particular situation clearly are high interest rates, which fortunately the Fed is being more optimistic about their perspective on rates. And while we expect a high rate or interest rate for longer, at least there's some stability in interest rates. And once there's stability in interest rates, we'll get the bond buyers come back in and fundamentally more liquidity, which is a great thing for the industry. It's going to take a while, but it's a positive. The path of travel is positive. The second thing that I think is interesting to think about is the fundamentals. And, I got to be honest, I was betting heavily that the consumer was going to run into a brick wall by now. And there is a subset of the consumer that has run into a brick wall, particularly the lower income consumer. So it sort of annoys me when I read articles where the author of the article does not bifurcate the income level in the consumer when they talk about the consumer. Because fundamentally, the lower end of the economy has suffered way more as a result of inflation than the upper quartile or the richest people in this country. And so when we think about that from a commercial real estate perspective, we see the fundamentals, particularly in assets that are more inelastic, the demand. So inelastic demand definition is it's the change in change in demand as a result of an increase in price, fundamentally at a definitional level. And we continue to see the consumer spend, which is healthy for all of us. On multifamily, the fundamentals, while there's a lot of new supply and some softening of rental rates, the fundamentals are really, really strong. I mean, you've got great government agencies to take you out. You've got historically high labor participation rates. You've got wage growth over 4%. You've got very high interest rates moving people into housing. And you've got a housing shortage. So fundamentals are really good. Industrial fundamentals are very good. Hospitality fundamentals are good. Retail fundamentals are good. Driven off of the demand from the consumer, from corporations, and thirdly, the demand that is driven by the government programs like the CHIPS Act, the Infrastructure Plan Act, and so on, that are pushing a lot more money back into the economy. So risk management in the interim was to deal with a lot of these interim-related problems, but the long-term fundamentals of commercial real estate, even in a higher interest rate environment, are actually solid when it comes to cash flow generation. I think one negative, though, Jonathan, as we've talked about before, is that there will be a reset in valuations. We are expecting interest rates to be higher for longer. And because commercial real estate is an interest rate sensitive asset class, the expectation should be that values should decline and then stabilize. And then over time, as the fundamentals catch up, we will see an inflation again of commercial real estate values.
So, Warren, I'd like to skip back to something you said in your first point, where you were speaking about local and regional banks. And I'd like to just unpack something there. And that is, we're seeing this massive shift, and I think ACORE's success is part of it, to what we call the shadow banking system. I think that it's a secular trend that doesn't seem to be going away, and recent events have kind of accelerated it. I think specifically, I want to point out a couple of things I pulled up here online that you jogged my memory, and that is that Jonathan Gray had some great little quotes in something he did recently, where he said he was talking about a certain bank, and he said that their problems are not caused by their super prime mortgage portfolio or with any issues with taxes or defaults, but specifically, quote, they failed because the mismatch of assets and liabilities. They had 20-year loans and 20-second deposits, 20-second as in like a third of a minute. And then, so how do you unpack that for our audience a little bit and where the world's moving with respect to ACORE's business and making loans that are multiple years long, and where you get your capital and what that means to the consumer.
Yeah, I think one is probably relevant to your audience too, is I'm sure there's a lot of borrowers of yours that are on the phone that you've sourced capital for them in the sort of regional banking system, because it is so big, you can't ignore it. It's a big part of the ecosystem.
Yeah.
The question really that we all have to face is, we use the word secular. You know, secular really is a sort of here to stay kind of comment. And I really believe that that is the case. There's not much that will move the regional banking system short of the Fed cutting rates. So the overnight borrowing cost of a bank when going to the Fed window, instead of 5.25% drops. That's helpful. Two is some kind of overnight offering that the banks can do if they're publicly traded, but that's a little bit more challenging. Three would be some taxpayer subsidized program like a TELF program to support and bail out the banks, but that's highly unpopular in an election year. So when you think about the banks, regional banks issues, the one other point I'd say is, to the extent that the regulatory framework changes the way in which regulatory capital works, that would also support and help unleash these banks. But all of that is going to take a while. So what's going to happen in the interim if you're a borrower in Kansas City and you build multifamily units, and generally speaking, you borrow from the regional banks, and that loan size is less than 100 million, I think that's going to remain challenged, really challenged for the interim. And you folks at George Smith will find the source of liquidity, I'm pretty sure, but it's going to be a lot more difficult to find. So when I think about it from the banking system, the other part of the bank's source of liabilities or cash is going to come from deposits. And to John Gray's comment, those deposits, one is 20 seconds is really 1 second, right? Because when you and I go to the bank and we say, I want $5,000 now, or I want to take all my money out of the bank has to provide the liquidity instantly. And when their asset side, where they're putting on 20-year treasuries, that to create liquidity in a rising interest rate environment on a 20-year treasury, you lose a lot of value instantly. And that's what happened to the regional banking system, right? And it really comes back to my first comment about it was the speed with which the Fed increased rates. Now, I know you have a lot of multifamily borrowers too. And a lot of multifamily borrowers, really smart borrowers, bought multifamily buildings at 4 caps and borrowed at 3.5%. That's
right.
Their expectation was rent growth, which I think we could all agree on. And secondly, probably a stable interest rate environment. So there are many very intelligent investors in commercial real estate that got caught there. The same way the banks did effectively, because that rapid rise in interest rates caught a lot of people. So how are we playing this through? The shadow banking system, or the non-bank sector, so this would be the mortgage REITs, the debt funds, the finance companies like ourselves, are going to become more prominent in the source of capital going forward. The banks, provided there continues to be a regulatory framework that is rigid and their cost of capital remains high, they are going to be secondary. The big banks face similar problems, but their balance sheets were more conservatively managed and so on. So, but the big banks, their intention is really, they can lend money to support debt funds in the shadow banking industry. They get better risk treatment. They get it's less risky, generally speaking, cross-collateralized if it's warehouse lines. So they're more likely to finance the shadow banking industry than they are to do more direct loans. Yep. Which is going to push the non-banks shadow banking industry to the forefront of the lenders in all these categories. So how are we playing it? By virtue of our scale and size, we will continue to gain market share. We are continuing to think about and innovate new loan products. What's interesting about your question, Evan, is that the thing that goes alongside what's happening here is also the evolution of private credit. And private credit is, this is the retail sector, this is pension funds, this is endowments, these are sovereign wealth funds that are looking to commercial real estate today as a safe place, commercial real estate loans, as a safe place to invest, a place where they can get cash yield, and the opportunity that is presenting itself because the banks are retrenching, where they can get better risk-adjusted returns. So there was a lot to your question. I just wanted to provide some context around it.
No, I appreciate it.
Adding to that point, just in terms of private credit, right? It's a very hot word that's being used widely, and I think it's having a moment for obvious reasons. With the banks pulling back, it seems that ACORE in particular is well positioned for that wall of maturities that's coming. Maybe call it 3 trillion in the next 5 years. Is that something obviously at the forefront of your mind?
Well, there's more than that, actually. I mean, so I often talk about the demand for commercial real estate credit, and I talk about the supply. So if we start with the supply, we know that the supply has shrunk because the banking system was the biggest provider of credit in the commercial real estate spectrum. CMBS has shrunk very significantly, although it's starting to make a resurgence. Insurance companies are an important part of the ecosystem. A few of the mortgage REITs are trading inside of book value, so don't really have the capital available to go and satisfy the demand. So the supply side of well-priced commercial real estate debt has shrunk.
Yeah.
The demand side, Jonathan, you're correct. It's 2.5, 3 trillion. It's a big number of demand over the next 5 years. But then think about the private equity firms that have formed about 500 billion. Yeah. This excludes the sovereigns and offshore companies, of capital that has been formed in private equity structures to invest in commercial real estate. And they got formed 2 years ago. So there's a J curve. So those private equity firms are sitting on the sidelines saying, when are we going to invest? When are we going to invest? They need to invest. Yeah. And they are starting to become more active now. So let's say it's 500 billion. So there's probably another 700 billion to $1 trillion of demand. So the demand for commercial real estate debt is probably $3.5 trillion over the next 5 years. And the real question is, where's that going to come from?
Yeah. That's a great point.
Great question. So let's dig into the other side of the equation a little bit and talk about where you're finding opportunities today. We've talked a lot about what you've done with your existing portfolio, but let's dig in on what is ACORE looking for with respect to putting out new capital and why.
So in times like this, when you have the banks, so let's just say what the banks were the best lenders for industrial, multifamily, self-storage, data centers, all the perceived safe asset classes. The banks provided the lowest cost of capital in the entire ecosystem, right? So in the last 12 months, 66% of our loan production has been industrial and multifamily. And those historically were sectors that were financed by the banking system. So to one of my earlier points, which is this retrenchment of bank capital, the pullback in bank capital has created the opportunity for non-bank lenders to lend where the banks used to be. Now, the problem for borrowers is that cost of capital is no longer SOFR 175. It's now SOFR 275 to SOFR 375. So they'll get a little more leverage, but the weighted average cost of debt by virtue of this secular change has gone up because the sources of capital are just different today than what they were before.
So yeah, not to mention, sorry to interrupt, Evan, all the deposit requirements of these banks, which is even further dilutive to your proceeds, right?
Yes. I mean, that's a good point too, Jonathan. Yep.
Let me just unpack that. Jonathan, you brought up a great point as well with deposits. When you're borrowing from a bank, I mean, I know, Warren, not to rib you too much here, but as a private, like, you don't have the same relationship with your clients that a bank does. Jonathan brought up the point of deposits. There are other reasons for banks to do loans and make loans, whereas you are looking at portfolio allocation, asset allocation, and your portfolio construct is probably more a top-down, I would imagine, construct than what a local bank would have, where they're trying to do business with their local clients, get their cash management, get depository relationships. And by virtue of that relationship, local banks might do things that would be very difficult for ACORE. Let me give you an example. Condo inventory loan. So you have a condo building and it's complete and you want to put new debt on it. And maybe it took a little bit longer to build than expected, and there were some cost overruns, and the prior lender needs to get out. So let's say it's a very good deal. And for ACORE, you guys probably want minimum yields of some significant number, maybe that turns out to be 18 months of time or something like this. Local and regional banks may do this, and just for a relationship, and they're okay with 3 to 6 months of minimum yield because they're doing lots of business with the customer. How do you unpack that potential weakness of your business model? And I'm not trying to dig in too hard on weaknesses here, but it's just something I'm trying to figure out with the broader shift that's happening right now.
Yeah, it almost doesn't matter, right? Because we talked about the demand for commercial real estate debt. And so there's a few things, we've always competed on speed, proceeds, flexibility. So I'm a borrower personally on multiple industrial deals and some student housing deals and so on. And the majority of what we did was bank-related stuff. Mm-hmm. But if you need additional flexibility or you need speed, you're not going to get it from most banks. You will on great relationship banks, by the way. I mean, but go back to our earlier discussion about the problems that the regional banks are having. So if you're a CEO of a regional bank and you got balance sheet issues, you're going to look at some of your best clients in a market like Kansas City, and you're going to say, sorry, folks, I just can't increase my CRE exposure today. There's nothing that you can do from a deposit perspective to change them. Well, I guess you could, because they could just lend over those deposits, but it will have to be a giant number. So, Evan, I think that there's a place for all lenders today. And I can't tell you the number of conversations I've had with private equity firms and others who want to get into the space. And I talk to them and I explain to them how our business works. And the reason I do that is I am a big believer in operating capital markets. The space is very big. And, you could take the biggest 5 of us and we don't even scratch the surface on what's going on. I
totally agree.
It doesn't scratch the surface. So deposits are a big part of the banking system, not a part of our ecosystem, but there's a place for everybody. And that's honestly, I want more liquidity in the system. I want rate stability. I do not want the Fed to rapidly reduce rates and then we run up against the reinflation cycle here, which would be a disaster for all of us. We want it slow and steady. And if we have slow and steady, I think that's going to be really good for everyone as cap rates settle in and fundamentals continue to be strong. I think that real estate as an asset class will continue to move along and do really well under that framework.
Speaking of new entrants to the market, it does seem that there is a shop opening up every other week focused on CRE debt, whether that's a natural extension of someone's business already, or a couple individuals who feel strongly that they have a good foothold. Though I think that one of the ways they can compete, which isn't necessarily good for their business, is they probably push on terms and they'll give on dollars and they end up caving on structure, which gets them the win in the short term, but could ultimately come back to bite them in the longer term. Have you seen that either in this cycle or previous cycles where that sort of happened?
Yeah, it's really coming into, call it post Russia, Ukraine, we were seeing a lot of them. And, my capital raising folks tell me there's like 100 debt funds in the market today. And but I don't see it that way. I look at it as who's our competitive set and who do we compete with. If you're writing 80 to $300 million loans, you need a big balance sheet to sort this out. Yeah. Whether it's having an availability of capital or whether it's having the balance sheet to cure any defaults or buy out your A notes or be a predictable long-term lender to your borrowers. Now, I know you guys do a great job. I mean, I bet if you're advising someone on a construction loan, you're not going to let them go with a poorly capitalized group who could not be here tomorrow, right? And I'm pretty sure you're going to pick the folks with bigger balance sheets for that, so that there isn't, oh, my lender BK in the middle of this equation. Yeah. The other point I would say is, I think there are too many players in the smaller loan, so let's call it below 30 million, because they got a warehouse line from, a big bank. Yep. They have 2 or 3 people. They're based in New York. They have a Bloomberg, and they think they know the business. I use the term ankle biters because I view them as ankle biters, but they don't compete with us. Occasionally they might, right? They might jump in and say, oh, we'll stretch, we'll be there, and maybe they'll do a deal. But I have a long-term perspective on this business. And over the long term, you need to be consistently in the market. You need to be able to support the borrowers in workouts. For us, we have about $17 billion of our capital is all whole loan capital, meaning that we control everything through the senior debt. So, of all of those modifications we described, we really make the decisions. And there isn't any complexity. I don't have to go to a co-lender and ask them for their permission. We don't need to do that. So as it relates to how we're positioned, I like to look at the landscape, admire it, occasionally comment on it, and we'll see how people do. But I'm a supporter of healthy liquid markets. And if people want to jump in, knock yourself out.
Yeah, so it sounds like, if I were to try to sum that up, correct me if I'm wrong, you're saying it's great that the market's expanding because more liquidity means a more stable environment for ACORE to operate.
Yeah.
Some of those groups may be successful, some may not be, some may become new competitors. Competition is probably good in the long term because it means more liquidity. It's a kind of a virtuous cycle.
Absolutely. But it's good for the borrowers too, right? So it's good for you, it's good for the borrowers. We see more transaction volume, and we'll just continue to build. My job as the CEO is to build our market share, right? So if I'm not building market share and the markets are growing, that's my problem. But I'm pretty confident in my ability to continue to grow our market share, given our position. I like healthy markets. I want to see transactions. One of the greatest things about our business, and I know you two will agree this, is the people. It's the transactions, it's the people, it's the experiences we all have. We only live once, and you sit at a closing dinner, and the stories we all have are great stories. And I think that's what we enjoy about our business. So when these markets are locked down the way they are, I can explain to people that we have disproportionate percentage of opportunities, but there's not enough transactions to make it that much fun.
Yeah, that's right. So thinking about workouts just quickly, because we're hearing a lot of borrowers, obviously we're speaking with a lot of borrowers, they're having trouble refinancing out of their current loans. And it ends up being that their current lender is the best lender, right? And as long as they can bring cash sort of to the deal to buy down the lender's basis to a reasonable price per unit, square foot, whatever the metric may be. Are you seeing a lot of that sort of in your portfolio? Are you finding that borrowers are sort of looking to work with you through that, or are they really truly looking to perform a repayment?
It's a great question. I think the vast majority is because of the lack of liquidity, and anything that's still in transition is, while we will talk about 100 debt funds out there, there's not a lot of liquidity on a percentage basis. It's talking about small dollars relative to all the demand for capital we've discussed.
Yeah,
we are the first stop as the incumbent lender, but for us, we really want to see a recommitment from the borrower to the deal in order for us to give them extensions, rate buy downs, all sorts of stuff like that. We want to make sure that the borrower is side by side with us. So what's going to be an interesting mental analysis for all of us, this wall of maturities that's coming up, how do those borrowers address the lender market and face the lender market? If with their existing lender they were unable to come to terms, that means they probably weren't willing to put up money to pay down the loan. Or the lender just won't extend because of capital issues, which I think is going to be more than 50% of their maturities. So, you know, in order for lenders, I would say in the non-bank sector, and I have the greatest respect for my competitors and the way they operate, we're going to want to see borrowers re-contribute capital to the deals in order for us to rewrite a 5-year loan. And will that happen? I think that is one of the next stories to be written. We'll have to see how that all works.
Yeah. Great. Well, I'll ask sort of one more question here, which is really focused on socially responsible or sustainable investing. I know that's been becoming increasingly important broadly across the industry with all the net zero targets, but also from an LP mandate perspective, when you're out raising, whether that's through insurance cos or sovereigns. And so is that something you're focused on at ACORE? Is that part of your debt strategy, just high level? And or would you allow any of these, call it esoteric type of financing structures into your stack to a certain detachment point, notably CPACE, for example?
Yeah, so we'll start with the CPACE. We've done, you know, there was a lot of talk about CPACE and a lot of activity in and around CPACE. I think we in the total portfolio have done about 3 CPACE deals. It has to fit and it has to work, and you have to understand the seniority of CPACE and what it means in your stack, okay? I think it's a very interesting tool, and I know, Jonathan, you've done a number of these deals, but it's an interesting tool to say, if you're in a workout situation and there is no money from the borrower, it can't come from anywhere, and the collateral is actually good collateral, it's a very interesting alternative for your borrowers to take CPACE. And the lenders, I don't know, say it generally, but you can convince the lenders that they should allow that to come into the structure as additional capital, yeah, if we believe it's great real estate. And I think that's where you get those deals done. It's the marginal deals where CPACE is, like, the ship is going to sink, and let's look at CPACE. It's not an intellectual way to approach the issue.
Sure.
Okay. So I think that CPACE on the ESG or DEI related stuff, you know, I was just talking about this before I came to this meeting. You know, I think I can only speak for ourselves and what we do. We have a ESG committee, and it's got 5 people on it. They're incredibly committed and passionate about the topic. Sometimes the conversations are combative and very passionate. But what we've been successful in doing is implementing a number of things, where it's the philanthropic, you know, effort of ESG. We're pretty good on that. The environmental stuff as a lender is more difficult to execute on. And it's more difficult because we don't control the real estate. Yep. So do we then make a decision that we'll only lend on, you know, lead certified buildings? That would shrink our business by 85%. So, and our investors would be unhappy with us. So the answer is no. The next question is, would we lend at a lower rate for an inner city project? Our investors would say, no, you know, that sounds interesting, but maybe one, you know what I mean? You know, so that's got its challenges. But we do track everything on every single loan on about 6 metrics, you know, and that then goes into a filter, and we figure out what we have. Not that we can control it, we can just look at what we have and comment on it, and maybe redirect the ship. Yeah. The DEI stuff is very important to us, and what we've tried to do. So at ACORE, we have 50%, just over 50% minorities and female employees, on 126 people, which is an I'm proud of, and that's grown over the recent years. The second component is our focus on internships for folks that are less privileged or have less access, or from sort of minority backgrounds. We do try and strike a balance there, that 50% of our interns are actually of those categories. And I would tell you, I personally get pleasure out of this, looking at it, because part of the issue that we've had in commercial real estate is that if one looks around to find a minority female senior executive, there are very few in the industry. And what we are proponents of is looking to the source in the internships and saying, can we provide a path for these folks that are otherwise were not represented in our industry, to maybe it's 10 or 15 years from now, to build a very senior role in commercial real estate finance. And the only way to do that is to get to the source, which is the universities, and do internships. So it's definitely a topic that we're very focused on, and I think we can improve every day, but it's really coming together in a good way.
So Warren, one more softball question. I think as we wrap up here, it's about time to wrap this up. But along those lines, what advice would you give to someone in college who is trying to break into the industry right now? I think it's a particularly tough time. Not a lot of firms are hiring huge incoming classes of analysts. So if there's any of those folks listening, what bit of advice would you give? And then we'll wrap this up.
So I recently did I was guest lecturing at my alma mater, and it was about 250 students about to graduate come out, and I said to them, you folks are the luckiest class that I can remember. And they all looked at me as if I was insane. Right. And I said to them, the reason I'm saying that is it is not about your starting salary. It's about your ending salary. It's about the experience. And I can tell you, I have some managing directors that have never seen a down market until now. Okay. You are going to come out as a student into a disrupted market, a confused market, an extraordinary market, and you are going to learn more in the next 2 years than some people learned in 10 years, because you don't learn as much in an up market and in a normal market as you do in a down market. So go into asset management, get your hands dirty. Do not focus on your going in salary. Focus on your experience. And the good news is there's going to be tremendous experience over the next 12 to 24 months.
Great. So Warren, where do people find out about you and ACORE Capital?
Website. It's the best place. ACOREcapital.com.
Okay. Well, really appreciate your time today. Thank you for joining us. And we will see you out there.
Absolutely. Thanks, guys. Keep doing the good work you do.
Thanks, Warren.
Okay. We'll see you.
Take care.
Bye-bye.